Hey everybody and welcome back. This video is going to be on understanding risk and understanding how to utilize that information in order to take proper trades. So what we want to cover is understanding risk. We also want to understand when to accept that risk and how to calculate the risk to reward probability possibly when you're taking a trade. Now, understanding risk, that when you trade, you're always going to have to risk capital to make capital. However, what you're risking is your hard-earned money, and what you're trying to do in that probability is get a high probability that what you're risking is going to give you the reward you're looking for. It's important to understand that the risk has to be worth it. If you're taking a risk that's not worth it, then you're making a bad decision in terms of being a trader. Now, let's talk about risk tolerance. Everyone is going to be different. Everyone is going to have a different comfort level, and it's also going to be based on the size of your account. So if you have an account with $100,000 and you're only risking 2 to 5% of $100,000, you're going to be risking a lot larger amount than somebody who has an account that's $5,000 that's risking 2 to 5%, which means that your drawdown and your risk amount is going to be quite different. Now, the more experience you have and the more proper your management is, you're going to understand this possibility and you're going to understand this process a lot easier, and it's going to make it a lot easier to scale. Anyone can hit a home run once. You only become great by doing the same thing over and over and over again consistently. So if you're taking high risk, that means you have high exposure, and that means that you have the ability to blow your account over and over again. So we always want to do what's called risk mitigation. Risk mitigation is the idea of trying to lower your risk as low as possible. It's the same thing that happens when you're driving a car and you put on a seatbelt. Risk mitigation is, can you crash in a car? Of course you can. Can you crash in a car and die? Of course you can. How do you limit the risk of you dying every time the car has an accident? One is you just put on your seatbelt. That's risk mitigation. So what you have to do is, before you take any trade, first you have to accept whatever risk you're putting on. Second, you have to mitigate that risk by making sure that you have a proper trading plan. This includes, like, let's say for example you take a trade, the trade costs $100. You must accept that if you lose $100, that was part of the plan. You actually go in thinking, I'm going to lose this $100. Now, if you end up going to the point where you make a reward instead, fantastic. However, your thought process always has to be, accept risk first. I'm willing to lose this money before I start trading. Quitting trades will also limit your growth, and it will also cause you to have loss if you start messing or tinkering with trades, which means that if you don't accept the risk and all of a sudden you go, I'm willing to risk $100, then you lose $20 and you go, whoa, 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 I don't want to lose $20, then you did not accept that risk, and that risk is too great for you. Now, risk to reward ratio, or simple risk to reward calculation, is based on the process of understanding that risk to reward has to be simple and it has to be worth it. So if you're risking $100, but you're risking $100 to make $300, that is a fair risk to reward. If you're risking $50 to make $150, that is a very good risk to reward. Now you have to be willing to accept the risk before you can gain the reward. However, if you're not willing to accept the risk, you cannot have the reward. So you can't play nothing and win nothing. You have to play something to win something. But let's always try to aim for a reward at a minimum, if you're doing swing trading, for example, of 3 to 1. Now here's a risk to reward per trade example. So say for example, again, if you're in this top corner here, you're like, I want to risk $20. Okay, you're risking $20 to make how much per share? So this is shares per trade. So now imagine that you're doing this with options. It's the same idea. So you'll notice that the risk starts to be the same. However, you're increasing the risk every single time you're moving up. So let's say for example you're risking $20. Your goal is, okay, let's say the trade costs $20. Let's say a company costs $5 per share. So you buy 4 shares. And as you buy the 4 shares, the price of the shares start to increase. So now what's happening is you're limiting your exposure of risk to only $20. Now what you're able to do is you're still able to buy a higher amount. So if this was options contracts, let's say price per share, you're buying an options contract, you buy one contract that gives you access to 100 shares. Once you make $60, you've actually done a really good job. So that's a 3-to-1 risk to reward ratio. Now we're going to do the same thing. If you were to make $40, you would be aiming for 120. If you had $60, you would be aiming for 180. Now this chart is just to give you an example of how you're doing your risk per trade and what your target might be if you're doing it based on the price per share. Now, this might be a little bit complicated for a lot of people to understand. So in this case, we're not going to dive super deep into it, but it's just a starting point to realize that once you start increasing the amount, the thing is scalable. The process is scalable. So you might say, hey, I'm risking $20 and I'm not making very much. But listen,
Order filled.
to the point where you're risking more money, you'll start making more money. Here is the example of a trade. Like this might be an example of a trade on EY Lilly that was taken, and the risk here was $1,500 if the trade completely fails. However, the entire target for it is $4,000. So this is about a 3-to-1 risk to reward ratio. Now, this might be too expensive for some people and say, hey, I'm not willing to risk $1,500. However, different stocks have different prices. So at this price point, this stock is about $700 per share at the time. Now, there's also way cheaper trades. You can trade something like Apple that might be $200. You might be able to trade something like Roku that's $60, or you might be able to trade something like PayPal that's $80, or Shopify that's $120. Like there are a lot of stocks, and a lot of them will be in your price range. So you find something in your price range to make it a lot more simple. Here's another example of the rest of that trade for EY Lilly actually. So the trade initially, the entire trade was going to be a risk to reward for 1 to 3. It actually ended up being closer to a 1 to 8. So when the full target was hit and it broke this structure and gapped up, we were able to take profit on here for $8,430 at full target, which that target was calculated based on the previous ranges. So this is just an overview, an example of why you might want to take a trade, why you might think that the risk to reward ratio is worth it, and why you might be able to put something up in mind. If you're the type of if you're a person who states that, hey, $1,500 is not worth the risk, but now if you take $1,500 and you make $8,000, that's the type of risk I would take 9 times out of 10. However, if this is something that is too rich for you, then think about it like this. If you're willing to risk $150 to make $800, then maybe that risk to reward is more likely your speed. Now, you have the ability to scale this. Stocks, everything are scalable. This doesn't have to be 100. This could be 1. This could be 5. It could be 2. The process and the idea is always going to be the same. You're going to take on the risk because it's what makes the most sense. Now, if you guys do need more help, we do have an actual school and a class, and it's a free community. You're free to join the community if you'd like, so that way you can actually see the full videos, because some of them are a little bit more lengthier and it's difficult to upload those onto YouTube. However, you can see the full videos if you'd like in the classroom, and feel free to join the Prosperity Trading School. Hope to see you guys next time.